Good evening, everybody. Thank you very much for joining in. This is 24th in the series where we're going to speak about one of the important topics in investment banking, which is known as how to fix a price. In the last video, we had spoke about the implications of ICDR. ICDR stands for Indian Capital Market Disclosure Requirement, wherein the company would like to raise money via IPO, initial public offer, FPO, follow-on public offer, OFS, offer for sale, right issues, stock splits, buyouts, safety net, private placements and all. And today we're going to cover about how to fix the price. Well, there are various methods of pricing which we're going to fix, but we are going to briefly touch upon each of them. From this side, I'm Rahul Magan, working as a corporate treasurer in EXL Services India. I'm also a treasury business consultant in various firms across the world, and also a founder of my own Foreign Exchange Academy, which is Foreign Exchange Public Thinkers, which is readily available on LinkedIn, YouTube and Dailymotion. I'm also a speaker for various firms across the world, which is roughly 26 in nature. And you are welcome to contact me at 998992429978, 9899242978, or rahulmagan8@gmail.com. I'm again reiterating the fact that today we're going to speak about the beautiful topic in the world of investment banking, which is known as how to fix a price. Now, there are two ways to fix a price. Well, basically, there are two ways to firm up a price. One is known as base price. Second is known as final price. Base price firm up is divided into three parts. One is known as DCF, discounted cash flow. Second is known as relative valuation. Third is known as contingent valuation. Now these three, the price which you are getting is further divided into two parts. One is known as book building and fixed price. And book building is further divided into two parts: Dutch auction and French auction. Well, today we are not going to discuss these things in detail. However, we are going to cover this fixed price and this in detail. Take a very simple example. Infosys is coming up with the price, coming up with an IPO, FPO, right issues, bonus shares and anything. Not right issues, because right issues are first basically given to the existing shareholders, right? It's coming up assuming IPO. And based upon this discounted cash flow method, they computed that the price of one Infosys share should be 2,500. In fact, 2,600. This should be a price for Infosys share because they are coming up with an IPO. Now there are two options for Infosys. As we all know, ICDR mandated every company to have one lead manager. Now you would have one lead manager, lead merchant banker. Then you have another book runner, and then you can say small player. You can say syndicate merchant banker. Now these three will take the two calls. The one is known as fixed price call, another is known as book building. Fixed price call means the company has decided, okay, fine, we're going to have one Infosys share price at 2,600. Second is book building. In book building, Infosys will take the prices from all the investors. Take an example. There are 5 investors: retail, corporate, QIB, foreign institutional investors and others. One is saying 2,600, 2,700, 2,750, 2,800 and so on. Infosys will create a book, and in this book, the book runner will determine what is the quantity an investor want to have at that price, and based upon that, they would compute the weighted average of that, and that weighted average assuming turnover to be 2,700. So Infosys would offload the entire shares of whatsoever Infosys is having at a price 2,700. Now basically, why book building? Book building is a big concept, because at the fixed price, sometimes you may end up having under subscription, or you are having over subscription, because as a company you always thinks you are issuing your share price at an intrinsic value. However, the person who would like to have your share may or might not think in that way. So in that regards, book building play a very important role, because in book building, the person who is taking your shares will take an appropriate call. Okay, fine, this much quantity of share price I would like to have, and I would say these are the quantities I would like to buy. You have foreign institutional investors, QIBs, you have retail investors, corporate, so on and so forth. So they will take an appropriate call. As a corporate treasurer, I would always recommend all investment bankers to have book building, especially under French auction. These two auctions, which is Dutch auction and French auction. In nutshell, I am touching. Detail we are going to touch tomorrow. In Dutch auction, all the book building done on the same price, which is weighted average income. In French auction, there are separate rates. Example, one tranche will come at 2,800. One tranche 2,000, say 790, one 277, one S 2650, and so on and so forth. So French auction would have multiple book building. On the other hand, Dutch auction would have only one book building. As a corporate treasurer, I would like to recommend that if you are going with either IPO or FPO, you should go for book building process, and you have to make sure that the lead managers, book runner, and the syndicate managers which you are taking must be appropriate in nature, or they should have an appropriate reach. And you should follow the French auction. You should follow the book building, and in book building you should follow the French auction. You're welcome to contact me at 919899242978. You can also email me at rahulmagan8@gmail.com. You can contact my LinkedIn, my Foreign Exchange Academy, which is Foreign Exchange Maverick Thinkers, which is on LinkedIn, YouTube, and Dailymotion. Thank you very much. Thanks for joining in. Have a great evening as well.